Welcome back to the deep dive. Today, we're taking on a term you've definitely heard before, probably 1,000 times if you spend any time online. Passive income.
Oh, absolutely. It's everywhere.
It is. It's sold to us as this golden ticket, right? The shortcut to financial freedom.
Yeah.
You see these images of people on a beach with their laptop, and the idea is money is just flowing into their account while they're, I don't know, hiking in Peru.
It's a powerful marketing hook. I mean, who doesn't want to separate their labor from their livelihood? That's the dream. But that dream, that marketing hype, it runs into a brick wall.
The brick wall of reality.
The brick wall of your accountant and, more importantly, the tax authorities. So our mission today is to really cut through all that noise. We're going to dive into the precise, the technical, and frankly, the often extremely narrow definitions of passive income.
Especially how governments like the IRS here in the U.S. actually see it. We're separating the beach fantasy from what you actually put on your tax forms.
Exactly. From the Instagram post to, say, Form 8582.
Okay, so let's build this from the ground up. Our sources for this are pretty technical. We're not giving out investment tips today. We're trying to understand how the system actually defines the money you earn.
Right. And to do that, we have to start with the most fundamental technical definition from the material we have. Officially, passive income is a type of unearned income.
Unearned. That sounds a little negative.
It's just a technical term. It means the income is acquired with, and this is the key phrase, little to no labor to earn or maintain it. And that's after the initial asset is in place.
After the asset is set up, that's an important distinction.
A critical one. It's usually combined with your regular job, your salary, but the single most defining feature is that you, the beneficiary, get this income regardless of your ongoing material activity in whatever is creating the revenue.
And that's the whole point, right? That separation between your personal time and your personal revenue. It's what makes it the holy grail for the whole FIRE movement. Financial independence, retire early.
Absolutely. If your passive income streams cover your monthly expenses, your monthly nut, you are, by definition, financially independent. It cuts the cord.
So it's really about owning capital, not selling your time.
Precisely. At its highest level, that's what it is. It's about leveraging ownership.
Okay, so our source material lays out the big classic examples. I see 3 main buckets here. First is owning financial assets, like an index fund that pays out dividends.
The classic portfolio stuff, yes.
Second, rental income, owning a property and having tenants. And third, and this one's a bit more vague, it's profits from a business where the owner does not materially participate.
The silent partner. You put in the money, but you're not running the day-to-day operations.
And this income, it doesn't always look like a regular paycheck, does it? The sources say it can come in different forms.
Right. It can be a big lump sum. Think about an inheritance. Or maybe you sell a piece of property that's appreciated massively over 20 years. That's a huge injection of passive capital.
Or it can be a steady stream.
Or it can be a stream, paid out over time. And this is where it gets kind of wild. Our sources point out this stream can potentially last for centuries, across generations.
Centuries?
Think about it. A huge portfolio of dividend-paying stocks, or a well-located piece of real estate in a major city, or even certain kinds of debt instruments. These assets can just keep generating income indefinitely. It basically makes a family wealthy just for the act of owning the capital that generates the return.
That idea of income lasting for centuries, that leads directly to the big critique of this whole structure, which you flagged in our prep.
It really does, because this is where the politics and the economics of it get very, very real. The source material we have highlights this major critique. Passive income structures are often used as, let's be blunt, sophisticated tax avoidance schemes.
Mostly by people who can afford the lawyers and accountants to set them up.
Exactly. High net worth individuals who can structure their income, so it qualifies as capital gains or these specific passive activities, which are often taxed at a much lower rate than the salary you earn from your job.
And that gets to the fairness of the whole tax system.
It's the absolute heart of the debate. The critics argue that because this capital-based income can avoid the highest tax brackets, the personal income tax itself has been, well, degraded. They argue it's basically become a wage tax.
A wage tax.
A tax aimed almost exclusively at the middle and upper middle working class. People whose wealth comes from their salaries, their wages, their bonuses, all of which are subject to those higher progressive tax rates. Capital gets a discount, labor pays the full price. We're going to see this theme pop up again and again, especially when we look at different countries.
That's a powerful framework. So, with that critique in mind, let's start breaking down the different types of income. To understand what's passive, we first have to understand what it's not,
Right. Let's start with its polar opposite, active income.
the one we're all very familiar with.
The one most people live on, yes. Active income is, simply put, income you get from performing a service. It's trading your time and your skills for money.
So, your salary, your wages, tips if you're a server, bonuses.
All of that. And importantly, self-employment income.
Mm.
If you're a freelance writer, a consultant, a plumber, that's active income. It also includes any money you get from a partnership or an S corporation if you materially participate in the business.
There's that phrase again, materially participate. So, let's use your plumber example. If I start a plumbing business and I'm the one showing up to houses, fixing leaks every day, that's my active income.
Clearly active, yes.
But if I just invest in my friend's plumbing business, I give her the startup capital, and I just get a check every quarter without ever touching a wrench, that's leaning passive.
Exactly. The entire distinction hinges on that one concept, material participation. The income is active if you meet the requirements, which, as we'll see later, are often based mainly on the number of hours you work. If you're involved in management, in daily operations, and the big decisions, you're active. If you're just a checkbook, you're passive.
Okay, so that's the active pole. Now, what about the category that gets confused with passive income all the time? Portfolio income.
Right. And it's an easy mistake to make. Portfolio income feels passive. It's the purest form of your money working for you. It comes strictly from holding financial assets.
Dividends from stocks, interest from a savings account or a bond.
Capital gains when you sell a stock for more than you paid. And in some cases, certain kinds of royalties. It's all income from capital, not labor.
But here's the first big technical trap, especially for our U.S. listeners. A financial advisor might tell you your dividend checks are passive income, but the IRS sees it very differently.
Very differently. This is probably the most important distinction we'll make today. The U.S. tax code has a super narrow category called passive activities. Portfolio income, your dividends, your interest, your capital gains is not in that category.
It's in its own bucket.
Its own separate bucket. And this matters immensely because in the U.S., portfolio income often gets preferential tax treatment. Long-term capital gains and qualified dividends are taxed at much lower rates than your salary.
Which brings us right back to that wage tax critique.
It's the mechanism for it. The tax code explicitly creates a financial incentive to earn money from capital portfolio income over earning it from labor or active income.
Okay, now let's tackle the new kid on the block, the one that all the online influencers are talking about, this idea of leveraged income.
Yes, the ebook, the online course, the software tool. Leveraged income, as our sources define it, is when you invest your labor once to create an asset that can then be sold over and over again.
So the work is all up front.
Exactly. The work is front-loaded into creating a scalable product. You might spend, say, 500 hours writing and filming a professional video course. That's a huge amount of active, difficult work.
No question. That is not passive.
Not at all. It's a grind. But once that course is uploaded and the sales funnel is built, the revenue can, in theory, flow in with minimal ongoing effort. You might answer a few emails, maybe update a video once a year, but the income stream is effectively decoupled from the time you spend generating each new sale.
So is it passive? It feels like it breaks the definition. It's a hybrid. It's a fascinating modern creation. It requires a ton of active labor to earn the asset, but the money it generates afterward behaves a lot like passive income. The key thing for, that ebook offer to remember is that while the income might feel passive, the tax authority is probably going to view the initial money from it as being fundamentally tied to your labor. It really disrupts that old school capital versus labor split.
That distinction is so important. It reminds you that passive doesn't mean the money just appeared from nowhere. It just means the person receiving the check wasn't the one who performed the final piece of labor that generated it.
The classic corporate structure is the perfect way to see this.
The stockholder getting a dividend.
Exactly. Take some giant multinational company. You own a few shares. When you get your quarterly dividend, that action is completely passive for you. You did nothing but own the stock.
But that dividend was only possible because of the constant active work of tens of thousands of employees. The people on the factory floor, the sales team, the engineers, they're all earning active income for their labor. The passivity is just a function of your position on the balance sheet. You're an owner of capital, not a seller of labor.
Okay, let's circle back to rental income because I think for a lot of people, that's the one that feels the least passive in the real world. You own a duplex, you get the rent checks, great. But then a tenant calls you at 3 in the morning because the basement's flooding. That's work.
And it's often hard, stressful work. Our sources are clear that rental income does require managerial and custodial duties. That's the friction. That's what makes it feel active. But the key difference here, the thing that preserves its passive status, is the ability to outsource.
You mean hiring a property manager?
A property manager, a leasing agent, a handyman on call, all of those people are earning active income for their services. But if you, the owner, can pay them to handle everything, your profit stream can remain entirely passive.
So the calculation for the investor is pretty simple then.
It is. Does my monthly rent check cover the mortgage, the taxes, the upkeep, and the cost of paying someone else to manage it all? If the answer is yes, you have a passive income stream.
And if you have to manage it yourself just to break even,
Then you're spending significant time on it, and the IRS is going to look at that much, much more closely. Outsourcing the management is the key to true passivity in real estate.
this feels like a good place to transition. We've defined the landscape active portfolio, that leveraged hybrid, and the technical definition of passive. Now let's get into the practical applications, the 4 core sources for building this kind of capital-based income.
Right, let's move from the definitions to the actual assets, comparing the risks and rewards.
And let's start at the absolute bottom of the risk ladder, deposits. Safe, stable, but maybe not that exciting.
Not at all exciting, but foundational. For a lot of people, this is their first and only source of passive income, the interest they earn from a high-yield savings account. You put your money in the bank, and the bank pays you a small amount of interest each period. It's simple, it's liquid, and it's usually insured up to a certain amount. Very low risk.
And a step up from that, still in the safe zone, are certificates of deposit or CDs.
Right, CDs are a commitment. You agree to give the bank a fixed amount of money for a fixed period of time. It could be 6 months, it could be 5 years.
And in exchange for locking up your money,
You get a better interest rate, usually a much better rate than a standard savings account. They're great for capital preservation. If you have money you absolutely cannot afford to lose, but you want it to earn a little more than it would in a checking account, a CD is a solid choice.
but they are very strict about that time commitment.
Oh yeah, try to pull your money out early, and you'll get hit with a pretty significant penalty. The whole model is based on them having your capital for that guaranteed period. And the formula is simple. The more money you put in and the longer you commit to leaving it there, the higher the interest rate they'll offer you.
So the verdict on deposits is they're a great low-risk anchor for your finances, but you're not going to get rich off of them. The opportunity cost is high.
Precisely. You're trading growth potential for safety and stability.
Okay, let's climb that risk and reward ladder. Next up, stocks. This is the main engine for wealth growth for most investors.
For sure. Stocks are where you can really see portfolio-based passive income take off. And you make money in 2 ways here. The first is value growth or capital appreciation. You buy a share for $100, the company does well, and now it's worth $150.
And the second way is dividends.
Right. Dividends are when a company takes a portion of its profits and distributes it directly to shareholders. That's a cash payment, usually every quarter, that you get just for owning the stock.
But investing in stocks, even a broad market index fund, is a whole different world of risk compared to a CD.
A completely different universe. Stocks are volatile. Prices can swing wildly based on economic news, market sentiment, a bad earnings report. Our sources even specifically call out the risk of so-called value stocks.
What are those?
They're stocks that seem undervalued by the market. They might have a lot of debt or uncertainty about their future. Investors buy them hoping for a big turnaround, but the risk of them failing is substantial. This is a game for people who are tolerant of risk, who can stomach seeing their portfolio drop 20% and not panic.
But the upside is that, over the long term, stocks have historically provided returns that significantly outpace inflation.
That's the trade-off. And within stock investing, the sources highlight a really powerful passive strategy, dividend reinvestment plans, or DRPs.
DDPs, how do they work?
It's a beautifully simple and totally passive mechanism. Instead of the company sending you a check for your dividends, that cash is automatically used to buy more shares of that same company.
So your ownership stake just keeps growing on its own.
It compounds. The new shares you just bought then earn their own dividends, which then buy even more shares. Over 20 or 30 years, this process can dramatically accelerate your wealth accumulation, all without you having to lift a finger or invest a single new dollar.
It's the ultimate set it and forget it strategy. Okay, so we have the safety of deposits and the high risk, high reward world of stocks. What's in the middle?
In the middle, we find bonds, which our sources describe as reliable debts.
Reliable debts. I like that. So what is a bond, fundamentally?
It's just a loan. You, the investor, are lending money to a big entity. It could be the federal government, your city, or a huge corporation like Apple. That big loan is just chopped up into small tradable units.
And the details of that loan are all spelled out.
Everything is spelled out. There's an issue price, a face value, which is what you get back at the end. There's a coupon rate, which is the interest rate. And there's a maturity date, which is when the loan is fully repaid.
So the passive income stream is that interest.
It's the coupon payment. You get a fixed interest payment at regular intervals, say every 6 months, until the bond matures. At maturity, you get your original principal back. It's a very regular, very stable, very predictable way to build passive income.
And in terms of safety, where do they fall?
They are arguably the safest financial instrument you can buy, outside of, an insured bank deposit, much less volatile than stocks. But of course, with that safety comes lower returns.
The classic risk-reward spectrum.
It's always there. That's why the standard financial advice for someone trying to build a balanced portfolio is to own both stocks for growth and bonds for stability. And it's worth noting, you can sell bonds before they mature, just like stocks. If interest rates fall after you buy a bond, its price will go up and you can sell it for a profit.
Okay, our last core source. Real estate and royalties. This feels like the oldest form of passive wealth.
It really is. And this takes us back to that 1930s concept you mentioned from our sources, from the economist J.A. Hobson. He coined the term improperty.
Improperty, that's a great word.
Isn't it? And it wasn't just another word for property. It was a critique. It specifically meant assets that are owned for the sole purpose of extracting income from other people, without the owner doing any productive work themselves.
So it's not about building something, it's about owning something that others need.
Exactly. The classic examples of improperty are land and housing, where the owner extracts rent from tenants, or things like patents and copyrights, where the owner extracts a royalty payment for the use of their intellectual property. Both provide a steady income stream and often have fantastic potential for the underlying asset to appreciate in value over time.
And the big advantage here, compared to stocks and bonds, is control.
Total control. If you own a stock, you have basically no say in how the company is run. If you own a rental property, you decide everything, the rent, the upgrades, who you rent to. But that control comes with a huge, huge downside. The cost of entry is massive. Buying an investment property can cost hundreds of thousands or millions of dollars. The initial investment for a down payment, closing costs, and getting the place ready is just astronomical compared to buying a single share of an ETF.
But for people who want the benefits of real estate without having to buy a whole building, there's a more modern option now, right?
Yes, real estate crowdfunding. These are online platforms that let a bunch of smaller investors pool their money together to invest in a big project, like a new apartment building or a shopping center.
So it democratizes access.
It does. You can get in for maybe a few $1,000s.
Yeah.
And you get the benefits, your share of the rental income, your share of the appreciation, without having to manage the property yourself. It allows you to be a truly passive real estate investor.
Okay, this is a perfect pivot point. We've talked about financial definitions, economic ideas. Now it's time to get into the weeds. For our listeners in the U.S., this is the most important part of the conversation: how the Internal Revenue Service sees all of this.
This is where things get complicated, and where the definition of passive income becomes incredibly specific and, frankly, counterintuitive.
The IRS, as we mentioned, has three main buckets for income: active, passive, and portfolio.
And that distinction between passive and portfolio is the one that trips up 99% of people.
So lay it out for us. What, to the IRS, is actually passive income?
It is an extremely narrow definition.
Yeah.
According to the IRS, passive income comes from only two types of passive activities. The first is rental activity. The second is trade or business activities in which you do not materially participate.
That's it.
That's it, which means all that interest you earn from your savings account, all those dividends you get from your index fund, that is not passive income to the IRS. That is portfolio income.
That is, I think, the single most important clarification we can make. $1 million in dividends is portfolio. $1 million from a passively managed apartment complex is passive activity income. Why does the IRS care so much about this distinction?
It all comes down to losses, specifically the passive activity loss rules.
Okay.
The general rule is that you can only use losses from a passive activity to offset income from other passive activities. You can't, for example, use a big loss from your rental property to reduce the taxable income from your high-paying doctor's salary.
Ah, I see. It's a firewall.
It's a firewall. If the IRS didn't make this rigid distinction, you can imagine what would happen. Wealthy individuals could buy up real estate, generate huge paper losses through things like depreciation, and then use those passive losses to wipe out all the taxes on their high-tax portfolio income from stocks and bonds. This rule prevents that.
Okay, that makes sense. So let's dig into those two categories. First, the trade or business where you don't materially participate. We keep using that phrase. How does the IRS actually measure material participation?
They measure it with what are known as the 7 material participation tests. The burden is on you, the taxpayer, to prove you meet one of these tests if you want your income to be considered active.
Let's go through the big ones.
The biggest, the clearest, is quantitative. It's the 500-hour rule. If you participate in the activity for more than 500 hours during the tax year period, you are materially participating. The income is active.
So if I own a little bookstore and I'm there working 10 hours a week, every week, I've cleared the 500-hour rule, it's active income.
Absolutely, no question.
But what if it's a very small business? Maybe it only requires a couple hours a week total.
That brings us to the second test. Substantially all participation. If your participation makes up, well, substantially, all of the participation from everyone involved, including people who aren't owners, then you materially participate.
So if I have a little side business selling things online, and I only spend 80 hours on it all year, but my spouse or an employee doesn't do anything, I'm still the one doing all the work.
You're doing all the work, so it's active. This prevents someone from claiming their income as passive just because the business is small.
Yeah.
There are other tests, too, like the significant participation activity rule, which is a bit complex, but it basically looks at your total time across several different activities. And there are look-back rules, like the 5 out of 10 rule, which says if you materially participated in 5 of the last 10 years, you're still considered active.
It's pretty clear they've built a very high, very dense fence to stop people from just, showing up for an hour a week and calling their business income passive.
An extremely dense fence, yes.
Yeah. Okay, let's move to the other big category of passive activity, rental activities. This seems more straightforward, but the sources say there are some major exceptions.
Right. The basic definition is an activity where people pay you to use your tangible property. But there are 4 key situations where your rental is not considered a passive activity, even if you're not personally involved.
And the first one feels like it was written specifically for the age of Airbnb, the 7-day rule.
The 7-day rule. If the average period a customer uses your property is 7 days or less, it is not a rental activity in the eyes of the IRS.
So short-term rentals, vacation rentals?
They are not passive rental activities. The IRS views that as running a hospitality business, which is an active trade or business. It's more like a hotel than a long-term lease. The constant turnover of guests requires a level of management that pushes it into the active category, regardless of whether you hire a company to do the cleaning.
That's a huge distinction. So if my average guest stays for 6 days, I'm running a business. If my average guest stays for 8 days, I might have a passive rental.
Wow. Okay, what if the stay is a little longer?
That takes us to exception number 2, the 30-day rule. If the average stay is 30 days or less, and you provide significant personal services to the guests.
What counts as significant personal services? This is where it gets really granular. Let's say you're renting out furnished corporate apartments for 3-week stays. If you also provide daily cleaning, a concierge service, maybe you stock the fridge, those are significant personal services. That makes it an active business.
But what if I just, have the common areas of my apartment building cleaned once a week? Or I send a plumber when a pipe bursts?
The IRS is very clear on this. That does not count.
Yeah.
Routine maintenance, repairs, cleaning common areas. Those are considered standard custodial duties of a landlord, not significant personal services. The service has to be specific and substantial to that customer's stay.
So the difference between a passive rental and an active business can literally come down to how often you change the towels.
It absolutely can. The other 2 exceptions are a bit more niche. One is for extraordinary personal services. Think of a hospital or a boarding school. You're paying for the medical care or the education. The room is just incidental. The other is if the rental is just a tiny part of a larger investment strategy, like you're holding land mainly for appreciation and you rent a tiny piece of it for a cell tower.
Okay, let's look at the second main type of passive activity again? Trade or business? We talked about the silent partner.
Right. A trade or business activity is just running any kind of business. The way it becomes passive is through your non-participation. The classic example is a limited partner. You provide the capital for a new restaurant, you get a share of the profits, but you have zero role in the daily operations. You don't hire staff, you don't choose the menu.
You don't meet any of those 7 material participation
You
tests.
don't come close. So your share of the profits is classic passive income under the IRS definition.
Okay, 2 final, very technical U.S. classifications from our sources. First, royalties. When are they passive?
This is another tricky one. The IRS says royalties are passive only when they are not derived in the ordinary course of a trade or business.
What does that mean?
It means if you are a professional musician who writes and actively promotes your music, the royalties you get are active business income. But if you, say, inherit the patent for your great-uncle's invention from the 1970s and you just get a check from a company that licenses it, that's passive. You're not in the business of inventing.
You're just a passive owner of the asset. And finally, something called self-charged interest. This sounds incredibly technical.
It is, and it's designed to fix a very specific potential tax problem. Self-charged interest can be treated as passive income if the loan proceeds are used in a passive activity.
Give me an example.
Okay, say you personally own LLC, and that LLC owns a rental property, which is a passive activity. The LLC needs cash for a new roof, so you, personally, lend $20,000 to your own LLC.
So I'm both the lender and, through my company, the borrower.
Exactly. Now, the LLC pays you interest. Normally, that interest you receive would be portfolio income. Meanwhile, the interest the LLC pays is a passive activity expense. You see the mismatch.
Yeah, I'd have portfolio income, which is taxed, and a passive loss, which I might not be able to use.
Precisely. The self-charged interest rule allows you to recharacterize some of that portfolio interest income as passive income, so you can offset it with the passive interest expense. It's a fairness mechanism for when you transact with your own passive entity.
The level of detail here just proves that this whole U.S. system is built to prevent people from gaming the rules. And yet the reality, according to our notes, is that only about 20% of Americans get any passive income at all.
And for most of them, it's a tiny amount, less than $5,000 a year, mostly from, a little bit of interest, some small dividends, or maybe getting rent from a roommate. The overwhelming majority of people are earning active income, which takes us right back to that wage tax critique.
It really does. Okay, that deep dive into the U.S. system is fascinating, and it shows just how much the tax code shapes the definition. So let's zoom out. How do other major countries handle this?
It's a great question, because the U.S. complexity really highlights what happens when a tax authority gets granular. Other places are different, and some don't even really try to define it at all.
Let's start with Europe. Is
Yeah.
there a single EU-wide definition?
Not at all. There's no single word or formal definition for passive income from the European Commission. Taxation is still a power held by the individual member states, so the rules for taxing, say, rental income in Spain, are completely different from the rules in Sweden. It creates a lot of complexity for anyone investing across the continent.
But there is some international guidance, right, from the OECD.
Yes, and this is very important. The OECD's Common Reporting Standard, or CRS, is a global framework designed to get countries to automatically share financial information with each other.
To stop tax evasion.
Primarily, yes. Now, the CRS doesn't formally define passive income either, but it gives a guiding list to all the signatory countries of what kind of income they should be looking for. And that list includes things like dividends, interest, non-active rents and royalties, annuities, and gains from selling financial assets.
So it's a much broader source-based list than the IRS's narrow activity-based one.
Exactly. The CRS is basically saying, if the income is coming from capital, not labor, we need to be tracking it. It's all about preventing people from hiding their investment profits in a low-tax country without reporting it back home.
Okay, now let's go to China, because this is where that tension we talked about, taxing capital versus taxing labor, gets really dramatic.
China is one of the most interesting examples in our material. China has a proportional or flat tax rate of 20% for passive and unearned income, especially capital gains.
A flat 20% tax on investment profits.
A flat 20%. Now, compare that to their tax on active income on wages and salaries. That's on a steeply progressive scale that goes all the way up to 45% for the highest earners.
Wow, so the incentive is incredibly clear.
It's massive. And the sources we have highlight the intense debate around this. Proponents will say that a low, flat tax on capital is good for the economy. It encourages investment, it attracts foreign capital, and it keeps wealthy people from just hiding their money. It's an efficiency argument.
But the argument against it, from an equity standpoint, must be huge.
It's the core of the critique.
Yeah.
Critics argue this system is fundamentally, or as they say, horizontally unfair. If a top surgeon earns $1 million through her labor, she could pay a marginal rate near 45%. If an investor makes $1 million by selling stock, he pays only 20%.
That's a massive difference.
It is. And the analysis in our sources suggests this structure fails to regulate the income distribution gap in China. In fact, it actively makes it worse by dramatically favoring wealth derived from ownership over wealth derived from effort.
It's a real-world example of that wage tax idea in action. Let's look at a couple of other specific examples. Russia and Kazakhstan have interesting approaches to securities.
They do. Russia's system is all about the principle of realization. They have a 13% tax on investment income, but it only applies when the income is actually realized.
Meaning when it turns into cash.
Exactly. When you sell the stock for a profit, or when you receive a cash dividend or a bond coupon. So if you buy a Russian stock and its value on paper doubles, but you don't sell it, you pay zero tax.
No tax on unrealized gains.
None. The tax event only happens when you liquidate. And it's worth noting that for non-residents, the tax on dividends from Russian companies is a bit higher, at 15%.
And what about Kazakhstan? They seem to use their tax policy to encourage local investment.
They do. It's a very targeted incentive. They have a low 5% income tax on dividends. But here's the key, that dividend income and any income from the stock's value increasing is completely tax-exempt if the stock is on the official list of the local Kazakhstani stock exchanges.
So it's a huge tax break, but only if you invest in Kazakhstani companies trading on local markets.
Right. It's a clear policy choice designed to keep capital within the country and to bolster their domestic stock market.
So if we bring it back to the U.S. one last time, just to frame all this, we have the three narrow IRS buckets: active, passive, portfolio, which are all about setting tax rules. But the sources mention the tax code also uses four broader categories to just define gross income.
That's right. And it's a useful final clarification. Those four broad source categories are just a list. They are 1. Income from labor, like wages. 2. Income from capital, like dividends and interest. 3. Income from transfer, like winning a prize or getting unemployment benefits. And 4. A weird one called presumptive income, which covers things like below-market loans.
And these are just to make sure all money is accounted for. They don't set the tax rates.
Correct. They're just a checklist to define what counts as income in the first place.
Yeah.
All the real policy work, the different tax rates, the loss rules, the credits, that all happens when the IRS applies those much narrower, much more complex definitions of active, passive, and portfolio. It really confirms that this whole debate is less about the general idea of work and more about very specific legal rules written to define the value of capital versus the value of labor.
A perfect place to wrap up our deep dive.
So we've gone on quite a journey today. We started with this, glossy promise of easy wealth, and we've ended up deep in the technical guts of global tax codes.
We certainly have.
And I think the most crucial takeaway for you, the listener, is that passive income isn't just a simple catchphrase. It's a highly technical, legally defined concept. And that definition can change dramatically depending on whether you're talking to your financial planner about your retirement goals or to your accountant about your tax liability.
That's the key. What an investor calls passive and what the IRS calls passive can be two totally different things.
Absolutely. The stock dividends that everyone thinks of as passive, the IRS calls that portfolio income. And it's not just semantics. It has huge implications for how your losses are treated and how your income is taxed.
For me, the thing that really stands out, the surprising fact that proves how technical this gets, is that IRS scrutiny of rental activities. That 7-day rule. The idea that if you rent your place out for an average of 6 days, it's an active business. But if you rent it out for an average of 8 days, it might be a passive activity. Or the specific definitions of what does and doesn't count as a significant personal service. It just shows that the difference between two completely different tax treatments can come down to whether you offer a daily turn-down service.
It's that granular. And that kind of detail shows you the complex guardrails that are required to draw a line between capital and labor in our economy. And that leads us to our final provocative thought for you to consider. Based on everything we've discussed, we've seen a clear global trend, right, in the U.S. with how portfolio income is taxed, and very sharply in China with their flat capital gains tax versus their progressive wage tax. The trend is that income from owning capital is generally taxed at a lower, often proportional rate, while income from active labor is taxed at higher, progressive rates.
The wage tax.
The wage tax. So the question to leave you with is this. What is the long-term impact of that policy choice on our very definition of effort in achieving wealth? And, more fundamentally, how might our tax codes, both here and around the world, need to evolve if they want to address this growing horizontal inequity between those who earn money with their time and those who earn it with their capital?